We're back on Morning Trade Live. Let's take a closer look at rideshare stocks. Lyft and Uber are both up more than 25% over the last 12 months, but both names have traded largely sideways over the last few months. Lyft popped after its last earnings report in early November, but is down 25% since that time. And Uber is positive so far in 2026 with a gain of more than 3%. So let's go inside out on ride sharing now, and joining us is Scott Devitt, Managing Director, Equity Research, Wedbush Securities. So how are you thinking about this space right now, particularly as I just mentioned, the performance we've seen over the last 12 months and, not a huge amount of action recently?
Well, I think you're balancing the short term where the business models are actually executing quite well against this long-term risk of autonomous vehicles, presenting a threat to the rideshare model by both potentially pulling volume off of the marketplaces and then even autonomous volume that does flow through the marketplaces being dilutive to take rate and overall margin. So I think investors are toggling back and forth between that short-term dynamic, which is the businesses are as healthy as they've ever been, and that longer-term risk.
Yeah, that has certainly been the consensus. Particularly around both of these companies. Operationally, it looks like many do believe that Uber is performing pretty well here. I'm just wondering, when you think about autonomous and then that long-term picture, how are both of these companies positioned for that, Uber and Lyft?
There's a lot of things that still need to be figured out. There's a school of thought that the technology of autonomous driving will be commoditized. It will be everywhere, and OEMs and private equity firms and others will put autonomous vehicles on third-party platforms like Uber and Lyft. And there's a school of thought that technology is a differentiator and that there's a scale dynamic here that leads to dominance by a few companies. So in the US market, you end up with Waymo and Tesla really dominating that market, extracting volume off of these services and becoming cannibalistic to volume growth. And that's more the camp that we reside in right now, but it's early days. Waymo's in 5 markets now, going to be in 17 by the end of 2026. Tesla's in 2, but they're not functioning in any, without a safety monitor quite yet.
Okay. So obviously we're watching to see how these companies are obviously going to be trying to convince the market about how they're playing the long game here, particularly around the autonomous vehicles, etc., and particularly when it comes to technology. But just as we stand here and now, how do they compare? Particularly when you look at Uber, how do you think about some of the areas that are driving growth, particularly around, the ride hailing and Uber Eats?
So the health of the economy is a big driver, travel is a big driver. And so to the extent that GDP, continues to show the strength that it has and the travel industry holds up, mobility should be strong. So for the industry, you're looking at, low double-digit growth. And because the two companies, at least in the US market, are acting more as a duopoly these days, margins are expanding as well. So Uber has margins in the low to mid-teens in terms of EBITDA margin, and Lyft in the upper single digits. So if you ended the kind of narrative there, they likely both be screaming buys. The question, that I think still needs to be resolved is just how autonomous plays out. And so I think you're going to see, just like the stock chart that you showed over the last 12 months, moves up and down based on where sentiment is at any given time around those topics.
So what's the next catalyst then? What have you got to hear from these companies in order for you to sort of change your thinking around this becoming a screaming buy?
So Uber's announced a few interesting partnerships, Stellantis in coordination with NVIDIA and Lucid and Neuro, but those haven't made it to market yet. So seeing how this kind of commoditization theory commercializes and whether it does or not would be something that would change our view. And then secondly, to the extent that Waymo and most notably Tesla, just take longer than anticipated to attain regulatory approvals and frankly scale their businesses, the longer that it takes, even if one is negative on the long-term implications, the better it is for the rideshare industry. So I think those are the things to pay attention to as an investor.
Right. Okay. We'll be paying attention to that. Thank you so much for joining us today, Scott, and getting us across your thoughts on the rideshare space today. Really appreciate it. Have a great long weekend. Scott Devitt there, Managing Director, Equity Research, Wedbush Securities. Let's trade it now with the host of Fast Market, Tom White. So an example trade for us this morning for Uber. Tom, what are you doing there? What's the approach?
Well, I kind of took that approach that Scott kind of mentioned. They're relatively neutral on the stock. So they report earnings at the beginning of February. So I looked at a strategy that kind of avoids that, right? There'll probably be some additional volatility, potential for big movements or big swings to the upside or downside. So I looked at a neutral strategy, and I went out to the January 30th weekly cycle. So just 2 weeks to expiration, where you're looking for a little bit more consolidation in this name over the next 14 days or so. So we're going to sell the at-the-money 83 strike call and put in the January 30th weekly cycle. So you're selling a strangle there, or a straddle, excuse me. And then against it, because I want to say risk defined, we're going to buy the out-of-the-money 78 strike put. And then on the upside, on the call side, we're going to buy the 88 strike call. So this is a short $5 wide neutral iron condor. We sometimes refer to this as a short iron butterfly because you're selling that same common strike, the 83, on the call and the put. On this short iron butterfly, we're going to collect a credit of roughly about $3.30. That's what you can potentially make if the stock kind of settles in around this 83 level over the next 2 weeks. Now, if I collect that $3.30 credit, that means I've got about $170 in risk either way, right? And that would be above 88 on the upside or below 78 on the downside. So that's where you don't want it to go. Now, if I collect that $3.30 credit, where do my break evens? Well, I need the stock to remain between about $79.70 on the downside and about $86.30 on the upside to be profitable on this trade. It's positive time decay, or theta, which means as every day goes by until expiration over the next 2 weeks, the option premium will come out of this strategy where it starts to decrease in value. The key here is price movement. You just want this consolidation that we've seen in Uber over the last couple of weeks to continue, and you avoid earnings on this trade also. So the idea is you sell it for $3.30, it continues to go down, and maybe in about a week and a half, it goes down to $1.50 or $1 because you're going to have some assignment risk either way. Where you can buy it back a little bit cheaper. But this just takes advantage of positive theta in this type of trade with a consolidation needed for this to work out.
All right, we'll be watching. Thanks so much for that, Tom White. I'll check in with you a little bit later on Fast Market. Thank you.